What's up, Gould Miners? Today, we welcome to the show Andy Hagans, the founder of Mastiff Equity Partners, a private equity firm located in Michigan, as well as the founder of OpportunityZones.com. Andy is a serial entrepreneur and businessman and an all-around expert in alternative investment strategies. After building and selling several successful companies, Andy took that knowledge and spun it out into a successful private equity firm. And today, we started guns blazing, with Andy addressing some of the greatest opportunities that he's seeing in today's market to build wealth. Later on in the episode, Andy shares some of the investing lessons that he's learned from networking and consulting with institutional investors such as family offices and larger fund managers. And finally, we spend a large portion of the episode discussing alternative investments, alternative investing strategies, why alternative investments have been on such a large growth trajectory over the last few years, and what you should consider before crafting your own alternative investment plan. Take out a pen and notepad, everyone. I learned a ton in this episode. I'm sure you will too. So without further ado, let's welcome to the program, Andy Hagans.
The Gould Mine Podcast.
Andy, welcome to the Gould Mine.
Thanks for having me, Danny. I'm excited.
Yeah, this is great, and there's a lot of synergies here. I know that we were talking offline here before we started that a lot of the things that you're doing right now are things that that I'm also kind of in the process of kickstarting myself. So why don't we start with just the question that's top of mind here for me, which is you've talked about building generational wealth extensively, right? In different podcasts, different shows. So we're sitting here towards the end of 2024. Mm-hmm. What do you consider at this moment to be the best opportunity vehicles to invest into for long-term wealth growth?
Wow. I hate to say it depends. It depends a little bit, right? I mean, I would say if you're a set it and forget it type of person, I'm not going to argue with Warren Buffett, like put your money in an S&P fund. And if you have the fortitude not to sell when the market is down, that's a pretty good option if you're just a set it and forget it and not a very hands-on type of person. But I'm guessing a lot of the people who listen to your show, Danny, are more hands-on and entrepreneurial. So, if you're a more entrepreneurial person, I do think private equity, that sort of hybrid of being an entrepreneur, being entrepreneurial with your investing is definitely the best way to make outsized returns. It's definitely how I've personally achieved the best returns is through private investments.
Okay, so let's dive deeper into that, right? Like let's talk about that, because you're saying entrepreneurial. So I like to think of investing. There's two different silos, right? There's the people that are like active investors. In reality, investments are their job, right? And then, so maybe they're like, for example, a hotel investor, right? Like me and my partners, we invest in hotels. Okay, but that's an active job, right? Because we're managing the day to day. We're asset managing. We're running the acquisitions process. We're doing the fundraising, all that good stuff. And then there's like the passive investing, right? So it's like, hey, if I want to invest into a private equity fund, or if I want to, if there's a group that I'm interested in investing with, and they're going to do all the due diligence, they're going to either run the deal themselves as the sponsors, or they're going to, invest via like an SPV into like a certain, investment opportunity. But that's more hands off, right? Like your job is to just identify a sponsor or a group or an individual that you trust with your money and trust to make the best decision possible with that money. So when you say entrepreneurial, I'm assuming you mean more along the lines of like active investments. Is that the case, or are you just kind of talking broader scope, like anyone that wants to be a little bit more aggressive with their approach? Do you mean entrepreneurial in terms of activity, or entrepreneurial in terms of aggressiveness?
So great question. And I think I mean both, because I look at active and passive as more of a spectrum than a binary, right? Like a binary would be, I'm either buying an S&P 500 index fund or ETF, and that's purely passive, right? I go to Schwab or Vanguard, I buy the fund, and I literally can just fall asleep for 30 years and wake up and like, boom, I got my returns. Purely active would be like what you're talking about. Like, I'm going to literally go buy a hotel, or I'm literally going to go buy a car wash, or I'm literally going to go buy a restaurant that's really more of a business as much as it is an investment. Like it's really only an investment in the sense that you're putting some capital to work, right? There's a purchase price to that business or that hotel or that piece of real estate, but then it's an operating business that requires that active management. So that's very, very active. I think there's also a middle ground, right? Where, you see a lot of like family offices doing this or real estate investors doing this where, well, number one, they're investing in something that they understand. Like oftentimes they'll have a passion for it, but they definitely will understand it. And so that in and of itself will make them more active, right? So for instance, even if you're investing as an LP, as a passive investor in real estate funds, but if that's the main concentration in your portfolio, well, you're going to have to take an active role in understanding real estate and being able to look through the offering memorandum and do your own kind of underwriting and vetting of all these funds. Like you're going to have to take a more active role, even in being a passive investor in like specific types of private equity funds or specific types of real estate funds. So that's just an example of, that's taking a more proactive approach. So there's a little bit of active, but it's also at the end of the day, you're an LP and it's passive. And so I think to me, I look at it as a spectrum. The more active that you're willing to be, generally, the higher the potential returns. But it's also more headache, right? It's more work, as you well know, running a hotel. I've never run a hotel, but from what I can guess or what I can imagine, it's quite a bit of work. Is that fair?
Oh yeah, 100%. I mean, and obviously you can, just like with a multifamily or any sort of real estate, hire a property manager and they take care of a lot of like the day to day, but you're still, even if you do outsource that third party to a third party company, it's still a lot of work,
Right.
like you still got like a ton of things to do and oversee. So yeah, absolutely.
Yeah. So I mean, I do think that's a personal decision and there's no right or wrong. I think you kind of have to know yourself. Like if some of us, like I grew up working with my dad, like my dad had a car shop. He sold used cars and they also did auto repair. It was a small business and I worked for him starting at age 12. And I just like absorbed, I think through osmosis, like his just entrepreneurship and just the idea of working for yourself. And so like, I basically just always knew that I wanted to work for myself. I wanted to be an entrepreneur. And I think there are other people who are wired like the opposite. Like I want to work 9 to 5 and then go home. And there's nothing wrong with that. Like I don't think that everyone needs to be an entrepreneur. I think it's just, you have to know yourself. And so you have to understand what kind of investor do I want to be? And you really have to start there rather than trying to, I don't want to make any judgments and say this way is good, this way is bad. I think it starts with just asking yourself, what kind of investor do I want to be?
Yeah, that's interesting. I mean, I would agree. I think everyone has different. It's funny because I think like there's some guys, right? Like they have a lot of money and they also have a lot of time because they're like closer to like retirement age, and so they get into this like bored investor phase, where they. Or they
100%.
just like need to make jobs for themselves to feel busy. So I think there's definitely like a lot of those people out there, and I think that's great, because it's like, hey, if you can make money and have fun while you're doing it, and keep yourself busy and occupied, and I think that's great. I think there's also a lot of people that like myself, who start from a young age. And they want to make this like their career, and it seems to me like you're kind of in that same bucket, right? So talk to me about that journey. How did we get to this point, and how did we get to where you are today?
Yeah, great question. Well, I think I already alluded to it. Just growing up, I got to soak up entrepreneurship, and just that sort of general philosophy, temperament.
Yeah.
Maybe it's in my genes. I don't know, but I certainly soaked it up working for my dad. And I had great parents who helped me get an education. And so I think it's important just to, acknowledge and have gratitude for, the other people who put me into that position where I could go to college. I met my roommate and he and I started a business in our dorm room. Right. So,
Sweet.
yeah. And again, like we built a business. We sold it. We built a second business. We sold that. But I do always just like to kind of reflect on like, where did it all start? Like, it didn't actually start in my dorm room, right? It started with my dad actually, and soaking up that philosophy from him. But my roommate and I, we went to school at the University of Notre Dame. And by the way, the first business that we started in our dorm room, that business actually did not work out, but it was one of those things that like, we enjoy working together and one thing led to another. And we sort of stumbled upon lead generation, which like I barely even knew what it was. And then I sort of learned, well, this is a whole industry. And this was like 20 years ago when we got into this. So again, just sort of through happenstance, we stumbled on lead generation and then the education niche within lead generation. And we built up a company from scratch that generated education leads and sold those to universities who were recruiting students. Everything from like the, DeVry's and like community colleges all the way up to like master's degree programs at different nursing schools. We sold that company. We ended up building another company with another partner called ETF Database, which was sort of an online resource that categorized exchange traded funds. And again, we built it up and we sold it. We had another liquidity event. And then I ended up building and selling another company. And after I'd gone through that process enough times, and it took me a few times, I realized like, why am I building these companies and selling them? Like, number one, after you sell the company, you get paid and like you have that moment where you're like, oh, great, I just got X number of dollars landing in my bank account. That feels great. And then like literally 5 minutes later, you're like, well, now what?
What's next? Yeah.
Yeah, exactly. So that's number one. And then the number two was, when you are just getting started, when you're in your 20s, if you can like sell a company, get paid a check and like go buy, your first home, it's like life changing, right? But at a certain point, and also you might have all of your net worth is concentrated in that like single startup company. So it might make more logical sense if you have an offer to sell the company to do it. But after I'd seen enough of these transactions, I realized, I think that the buyers are actually making out better than the sellers on a lot of these deals. And I it's not like I regretted selling, but I kind of realized like, I think maybe I want to start buying companies, not selling them. And so that's what led me into the world of private equity and private investments, which, like I said, it's really, to me, it's another form of entrepreneurship, but you're combining it with, you have capital. So you're able to purchase a business or purchase a piece of real estate, but then through your expertise or your sweat equity or whatever, there's also that entrepreneurial element to it.
That makes a lot of sense. So it's interesting kind of hearing your background, right? Like you have a really strong business background. You bought and you built and sold several companies. And I think like it's unique because I think that a lot of people kind of come from like an investment banking background or like maybe like a consultant background. And so they've never really truly gotten their hands dirty, right? They don't really know what it feels like to go through what most entrepreneurs go through, right? And so I think that, that the relatability factor there when you're trying to understand or dig deep into like a company's, story, whatever, like if you're making an investment into like a business, for example, you probably have a better read on things than like most other like fund managers is what I would expect, just kind of like hearing your story. Talk to me about, because I know that you're also big on, like you do have some real estate stuff going on too. And so when did you first venture outside of like the business world? Like, could we call it venture capital? Like, is that what you were doing? Like a lot of like or VC adjacent? Like what are we doing? Are you just buying businesses or investing into the businesses? Like which one, or both?
Yeah. So my, the companies that I sold that we just built up from scratch, or you might call them like angel backed or something. They were definitely startups. How I got into, I never got into venture capital. I was always wary. Like we probably could have raised venture capital for some of the startups I was involved in, but I was always wary of, giving up control. kind of heard horror stories. And I know some entrepreneurs have great results working with venture capital firms. But for me, I just realized, that wasn't a route that I wanted to go down. And I will note also that I'd always kind of throughout my 20s looked at real estate as like, I think real estate is boring. Like, surely you can't, generate very high returns from such a competitive asset class, sort of boring and competitive asset class. So I pretty much ignored real estate for like the first decade of my career. And how I got into the real estate industry was almost backwards, right? So one of my business partners, Jimmy Atkinson, he had started a company focused on the Opportunity Zones program, it's a tax incentive program for real estate projects. And he called me and told me about it and, told me what he was doing. I was like, oh, that's really cool. And I gave him a couple tips, which I want to note for posterity, a couple tips that actually really helped the trajectory of his business, helped it take off. And we were talking maybe 6 months, 12 months later. And he was like, I really need help scaling this thing. Would you consider coming aboard and really helping me figure this out? So I bought into that business, which is now known. We rebranded as opportunityzones.com. We finally got the premium domain name. And nice. Through that business, we've been now working for 4+ years, advising, consulting, helping doing marketing for all of these different private equity funds. Most of them are Opportunity Zone funds, although we've worked with and worked for some other different kinds of alternative investment type private funds. And I've just sort of soaked in the industry just from that consulting side and marketing side, and really learned to love it, to be honest with you. Like, it kind of like it took a little bit for real estate to kind of get into my blood, but I saw, within real estate and within alternative investments right now, there is so much change occurring, right? With the 506c ability for independent operators, guys like you or guys like me, or just whoever who becomes an expert in a particular asset class, to create their own fund, to launch their own fund, to compete with the big guys, the Blackstones, the BlackRocks, the really huge asset managers, and do this kind of, investing thing, private investments, do it differently, do it as independent operators. And there's a little bit of that Wild West element to it that I think is kind of exciting, but it's also just exciting to be part of an industry that you're sort of seeing it, go through its like infant stages and baby stages. And maybe now it's like a toddler, and it's just really fun to be part of an industry where there's so much grassroots growth occurring.
Yeah. So on that note, right? Because I'm sure that there's plenty of listeners that are looking to take a more like active role and launch their own funds. So what is the thing that excites you the most? Because you called it the Wild Wild West, right? So Wild Wild West was equally exciting and dangerous.
Yeah.
So what excites you the most? And then what are the biggest kind of like kind of red flags or things that kind of make you think twice about what's going on right now? So walk me through that.
Yeah. So I guess what excites me the most is that, it's like there's within reason, there's no asset class that's really off limits, right? So there's all kinds of unique niche asset classes, sectors where there are funds popping up where beforehand there either wouldn't have been the scale or the management expertise, or maybe it's a sector that's just too small for like a Blackstone or some big company to launch a fund in. And so that's one thing that I love, is that like, if you go around the country, you meet different entrepreneurs, you meet investors, fund managers, there are people and experts of asset classes that you just didn't even know existed, let alone that there would be like a private fund investing in that asset class. Right. So I think that's very, very exciting. And I also think that, the 506c, which is that ability of a fund to register where they can do direct solicitation. And so what that means is that the fund sponsor, the fund manager, doesn't just have to raise funds through a broker dealer, right, through a network of financial advisors, but they can actually raise funds directly from investors. And so I think it's also exciting to watch relationships develop between LPs and investors and the fund managers. And I can tell you, having witnessed a lot of investors making these investment decisions, a lot of times it's not actually coming down to the numbers. It's coming down to they have a passion for a sector, or they really respect the philosophy or what the motivations of a particular fund manager, and they build that relationship. And so it really does become more, than just about just the money.
Mm-hmm.
That's very exciting. As far as what scares me, the hurdle has been lowered to launch a fund, which I think on a net basis is a great thing. But that does mean that some people launch funds who have no idea what
No
they're
business.
doing,
Yeah.
or maybe, to be fair, I think sometimes also they know just enough to be dangerous, right? So like one company that I would point to would be Inland. Inland, they sponsor a lot of DSTs, which is like a real estate product that allow people to do 1031s and do a passive vehicle. And Inland has been investing in commercial real estate for, I don't know the exact number of years, but like 50 years, right? So they've been through several market cycles. They've been through bull markets, bear markets, low interest rate, high interest rate. Like they have that institutional knowledge and that viewpoint that comes through having survived several market cycles. What I think is a little scarier is all of the fund managers who launched their funds in like 2019, let's say, and then that was like their first fund. And it's like, you had a couple years that were crazy good. And then all of a sudden interest rates spike. And so now you're kind of seeing the fallout from that, where, okay, this new breed of fund managers who was responsible and who wasn't. And sometimes, they'll launch their fund with the best of intentions, but because they don't have that track record or that deep experience, that ends in a not very good result for them, or unfortunately for their investors. So I do think, and I think it's important to talk about that, because I think for LPs, for investors, for the passive investors, right, they need to understand that obligation to themselves to do due diligence, not only on the funds, but also on the fund manager. In fact, I think that's the most important due diligence you need to do as a passive investor, is the people that you're investing with, right, their track record.
Yeah. I definitely agree. I mean, I think that, but pretty much across the board, anyone that I've ever asked that knows anything about anything, when I ask them, hey, like what do you look for when you're vetting a deal or anything? That's like, oh, well, forget the deal, right? Like we're just focused on the sponsor, what their track record is. And even if they don't have an extensive track record, just understanding who they are, mm-hmm, and what they bring to the table. And do you feel comfortable? Do you feel like they're going to be, as my buddy Lance says, good stewards of your capital? I think that's like super important. So, on that note, Andy, up until this point, kind of walk me through, because I think I have an understanding as to like how you operate, but I want to be super clear, right? So when it comes to like investments and stuff, obviously you're investing some of your own money, but are you acting in like more of like a fund of funds role where you're helping people invest into these deals alongside of you? Or are you the GP and you're raising and these people are coming in as LPs? How does that, like, walk me through? Is it both? Like, walk me through how you've been doing it so far.
Yeah, so great question. And maybe there's two sides to that, because there's my personal investments and what I'm doing with some of my personal capital. And then there's also the business that we've kind of alluded to, opportunityzones.com. So let me actually take that one first. At opportunityzones.com. So Jimmy and I, we've been fortunate enough to build like a really big email list of over 20,000 investors, a huge portion of which are accredited investors. And so there's a lot of folks coming to us who are interested in private investments, private equity funds, real estate, tax advantaged funds, all those sorts of, types of funds and that style of investing. And they're looking for deal flow. They're looking to see what funds are out there. And so opportunityzones.com, we run these events, and they're almost like, you could almost call them like matchmaker events, where we have private equity funds, mostly real estate, come and talk about their company, what they're doing, and essentially pitch their deals. And so they're our revenue source at opportunityzones.com, are the sponsors who come and pitch their deals at our events. And then from the investor standpoint, it's free to attend their virtual events. And then we also do educational content. We have panels, expert panels, talk about the state of the market and all that sort of thing. So that's what we do at like the company level. We're not directly investing into any of those funds. We're not getting like a commission or anything like that. It's really just producing information. And I also think we've done a good job of sort of building a community. So sort of kind of a go-to virtual hub, I suppose, for a lot of these kind of funds and investors who are interested in them. And then on a personal basis, so now kind of shifting away from opportunityzones.com, just talking about my personal investing. I mean, for me, it is as much about passion as it is about, the math. Is just, I love entrepreneurship. I love investing. I mean, for me, this stuff is fun. So I do have a very proactive investment style. So I've invested in several different private businesses over the years. I've invested as a limited partner in different private equity funds and real estate funds. And then recently I've just done my first commercial real estate deal where I was the principal, and did that myself. And again, I'm into this stuff as much for passion as I am, for the returns. Although I do think the returns are better with that style of investing.
I want to go deeper into that, but before I do, selfish question here for you: 20,000 investor list, 20,000 name, and I'm assuming contact information, all that stuff. That's a massive list. So, what would you say are the three main strategies that kind of like helped build that list? Like, what are the main lead pillars that you're using to kind of generate leads for that list? Obviously, you have a lead gen background, right? So, it sounds like you've done a good job of translating those skills into this new silo. So, how have you gone about building that list?
Great question. And one I didn't, prepare for or anything, but I love talking about marketing. So actually I could talk, we could have a whole conversation just talk about marketing and lead generation all day. But the baseline, I would say for marketing, the baseline of really any project I do, and including what we've done at opportunityzones.com, is content marketing. So to me, you have a brand, you want to stand for something and have a story behind your brand. And Opportunity Zones, I think they have for their target audience, they have a good story, which is tax advantaged investment in real estate. So you have that core brand and that core story. And then by producing content, I really think it's the best way to just do marketing in general, because it allows people, I won't say consumers, I kind of hate the word consumers. It allows consumers, it allows people, it allows investors to get to know you, to learn your story. And also it allows you to build trust, build a connection with them. Because if you're producing good content, so for instance, Danny, like your podcast, right? You're producing good content. So all of your listeners, they're getting to know you, they're getting to like you, they're getting to trust you, and they're learning something from you, right? So you're already giving them something of value for free. So that's the baseline, I think, is good, solid content marketing. The second thing, I'm a big believer in like these specific channels of audio, video, and email. So podcasting, or even better yet, video podcasting, or some kind of a YouTube channel. And then, the kind of the old school, the money's in the list mindset of always be building that email list. So like there are so many different channels and social media platforms. And I think it's easy for businesses or content producers to kind of get lost and go, how do we prioritize? Which channels should we focus on? So for me, it's a little easier because I just kind of have maybe they're biases or whatever, but I think especially, in the niche that you're operating in, that I operate in, I think that audio, video, email are just very, very proven. And then the last thing, and again, this is old school, is have a good lead magnet. Have a free guide, a free report, a free checklist, a free class, free this, free anything, but that's something of value that really relates to your market. Right. So like in our case, we have the beginner's guide to opportunity zones investing, which almost anyone interested in opportunities investing, like they're going to want that guide if they're just starting out. They're going to want to learn the basics of the program. It's like a 10-page guide. It's free, but the quote unquote catches, you trade us your email and you get access to the guide. And so we've used that, again, all these things, they've been around for a long time. So it's nothing new. But I think they still work. They're proven and they still work.
No, I couldn't agree more. I think that, especially in the day, I mean, it's never been easier to generate leads, right? Like,
Yeah.
I can't imagine what it was like you said 2004. My God, like, what did you do? Make cold calls all day? Like, there's right. Like, there's really, I mean, the advancement in technology has been so crazy. And when I got started in 2013, I remember like its ads were just starting. And I wish I had the foresight to like just put like all that money into like Facebook ads at that point. Cause it would have been, it wasn't until 2017 that I started running ads on Facebook, but by then it was already like, from 2013 to 2017, even then there was a huge difference there in terms of just like, CPC or CPL and so now it's just, it's a lot more expensive. Yeah. On LinkedIn, it's like almost $70 for a lead now, I think on LinkedIn, depending on,
it's crazy. And that's why I go back to my belief in content marketing, because for some companies, it's not a fit because they just won't have anyone at the company who actually wants to create content. But I think more and more companies have kind of woken up to that. Even corporations and mid-sized companies, like it's going to be, at the end of the day, probably one of the most cost-effective ways to spread your brand and get awareness of your products and services.
And speaking of content marketing, you are you have a podcast, and so it's called the Alternative Investment Podcast, correct?
That's right. Yep.
Nice. All right, cool. We're going to link that below. So if you're interested in learning more about alts, and so like, I'm assuming that do you have other guests on that come on, talk about different alts that they're experts in, or so? How does that podcast work? What are you doing on that, Leslie?
Yeah, a good question. I should mention we're in between seasons right now, so I haven't published any in a little bit, but the backlog, we have a ton of episodes online that are obviously archived and available. And I'd like to think that we've covered almost everything. Like if it's that's not quite true, in the sense that ultimately I've chosen all the guests, and if someone doesn't kind of pass my filter, then I won't have them on as a guest. But I mean, we've done everything from private credit, private equity, and a ton of real estate, but we've also done, some like life insurance settlements and just like all kinds of things, collectibles, art, just things that, if it's an alternative investment, it most likely in 2024 is being packaged in some sort of fund or available on some sort of investment platform. And there's a ton of interest in it. And I think the interesting thing is, if you look at the alternative investment category as a whole, number one, it's already big, and it's been growing at a very healthy pace for over a decade now. But the interesting thing is, its growth is not slowing down, right? And if you look at younger investors, not only millennials but Gen Z, like they are very much embracing alternative investments, more so, I think, statistically more so than like the baby boomer investor generation or Gen X. Things like crypto and real estate and these alternative investments just seem very natural, whereas I think 20 years ago they were not the norm.
So, and what's interesting is I was just watching CNBC the other day. They had some sort of alt guy on there that was, talking about the growth trajectory of alternative investments, and just how, crazy the growth had been over the last couple of years, and how they expected. So everything that you just said right now, he was echoing pretty much to a T. Why do you think that is? Right? Because you noted the shift in generational tendencies. So you're saying, hey, boomers were more conservative. Now, these newer generations are a little bit more open to these sorts of investments. So that has to be part of it, right? It's just a generational tendency and habits. But what's driving that, do you think?
So that's a good question. And I think it depends on the investor. But the single biggest thing I would point to is that historically, and especially in the larger alternative asset classes like real estate, including alternative assets in a portfolio will tend to reduce that portfolio's overall volatility. So I think most investors or advisors or family offices who are investing in alternatives, and especially the more like quote unquote traditional alternative investments, which maybe that's a funny phrase, but I think you know what I mean probably by it. They're looking to reduce volatility. And I think even family offices, who might be managing a $500 million portfolio, and they'll go out and buy a Class A apartment building for $20 million. Just the idea that something that's tangible, that is not being repriced each and every day, each and every moment of each and every day by the market, it just feels more solid. It feels less volatile. And I think that there's also some pretty compelling research that including alts in a portfolio reduce that overall volatility. So I think that's the single largest factor. Is I think a lot of investors are looking to reduce their risk. They're not necessarily looking for higher returns. So I think that's interesting. Is that the biggest driver is actually that decrease in portfolio volatility. But the second thing, because I mean when you mentioned like Gen Z or younger investors. I think to the extent that investors are looking for more speculative investments, right? So like kind of that different side of alternative investments that's not kind of the more stable real estate sectors, but the more speculative stuff like crypto or investing in wine futures or whatever. I think a lot of younger investors
sounds interesting.
I think a lot of that speculative energy used to be in the stock market or just trading options. And there's still, of course, there's lots of day traders and people who are speculating on the stock market and options and futures, and things like that. But I think that there's a portion of especially younger people, to the extent that they want to speculate, they're doing it with crypto or they're doing it with other non-traditional investments.
So I guess my first question coming out of that is, because I've heard arguments for both sides of the, I've heard both sides of the argument, which is I've heard people say, yeah, real estate is an alternative investment class. And then I've heard some people say it's like real estate is not alternative investing. It sounds like you consider it alternative. Walk me through that, right? Walk me through why you would consider it alternative. Is just because it's outside of the stock market, and anything outside of the stock market is considered alternative, or what would your retort be to someone that says like real estate's not alternative? It's just regular investments. You call it traditional alternative, right? So.
So I'll answer that in a couple different ways. Well, first of all, I'd give a technical definition of alternative investments, which maybe doesn't exist, or maybe depends on who's defining it. But the way I define it is anything besides stocks, bonds, or cash-like instruments. Because those are the traditional investment markets that are with stocks and bonds and, stock funds and bond funds. They're publicly traded and they're highly liquid, right? So real estate, people might perceive that as like, well, that's pretty traditional, but depending on, the details of how it's owned, like, is it a part of a fund? Is it in a REIT that's publicly traded? Is it just an individual property that you own? Usually it tends to be illiquid. And so that's what would define it, real estate generally, as an alternative or an illiquid investment compared to stocks and bonds and ETFs. Those are very liquid, so they're traditional investments. One other note I would make is just sort of, colloquially or whatever, when you talk to like older financial advisors or wealth managers or family offices or even people in the industry, a lot of times they'll say alts, right? They'll say alternatives or alts, and they're literally just talking about real estate. Like they're not even talking about any. So to some people, like, it's kind of like, I don't want to fight what people in the industry, the terms that they're already using. So
yeah, no, 100%. And that's well, that's one of the reasons I asked you, right? Is because I feel like everyone has a different definition, and it's like, well, what is it? What is it not? I like your definition though, which is anything outside of stocks, bonds, and cash or cash-like instruments. I mean, I think that that's pretty straightforward. It also the idea of like more traditional alternative investments, which would be your real estate, you know, and things of that nature, and then you know, outside of that is like the more, like you said, speculative or riverboat gambler, right?
Yep.
Type investments. So yeah, it's interesting. Well, and I also think like in the real estate sector too, there's a huge variety, right? And just, you know, because I'm a real estate guy, right? And so I think that at this point, 15 years ago, I think that any sort of real estate investing could probably be considered alternative. But at this point, I think that there's so much information on residential properties, right? Single families, multifamily apartments, all that good stuff. But, you know, especially single families, right? It's like there's just such a wealth of it, like a plethora of information out there that it seems to me like that's becoming more of like a traditional investment strategy, or at least it comes into people's heads almost as much as like investing in stocks. However, stocks is like easier because you just give it to someone and say, make me money. But with real estate, you kind of have to like either know someone that knows how to do that or learn it yourself, right? Or find someone to teach you. And there's just more work, there's more energy involved, right? And so
Totally.
yeah. And so on that note, right, like it sounds to me like you're saying, okay, the more energy you can put in, usually the better the returns are going to be. I mean, I don't know that I disagree there, right? I think that like the more elbow grease, so to speak, right, that you can put into something, like the better the payoff is going to be for you. When have you seen that not be the case though? Like, has there ever been a situation where that is not the case, right? Where people put in a bunch of elbow grease and don't get those returns?
I think that's a fantastic question. And like, I'm glad you asked it. I'm glad we're talking about it because it does happen, and it happens quite commonly, right? Like, so you can even see that in like the entrepreneurial world, right? So I mean, I kind of defined it as like there's a spectrum between investors who want to be entirely passive and then investors who want to be more active and more entrepreneurial. But if you look into the startup world and you look at the failure rate on startups, or even if you look at certain industries like restaurants, I don't know what it is for hotels, but the failure rate for restaurants or startup, like it's
super high.
It's very, very high, right? So number one, just understanding that going in, and, you know, so like if I start a new business tomorrow, like Danny, let's say you and I have a great business idea. We want to be business partners. We're going to launch our new business tomorrow. I'm not going to invest 100% of my net worth in the new venture, right? So just like kind of that basic risk management is a skill that not everybody has in terms of managing their portfolio. And when they're investing in riskier things, you know, limiting the amount of damage that can do to your overall portfolio. So that's one piece of it. And then, you know, it's also one of those things that I try to speak very broadly in terms of including alternatives in a portfolio will usually lower that portfolio's overall volatility, or often more active investing can increase overall returns, because there's just a ton of exceptions, right? Like you could have said, it's 2019 and I really want to get into alternatives. I'm going to take 50% of my portfolio. I'm going to cash out of the stock market and I'm going to invest in all these multifamily funds, you know, these value add multifamily funds. I'm going to do that in 2019, Q4 2019 or whatever. And in all likelihood, you know, those investments would have done very, very poorly. So there's also, you know, there's just, you have to know what you're doing. You have to know, so you have to approach it from that more, I don't want to say professional standpoint, but maybe a disciplined, intelligent standpoint where you're investing in alternatives, whether it's venture capital or startups or private equity or real estate. Number one, just having that responsible overall portfolio allocation and being disciplined with it. So like understanding that not every investment or every fund is going to work out. And then secondly, doing your homework, right? So like if even going back to that example, let's say you did invest in multifamily in 2019. Well, there are probably more solid operators who launched funds in 2019 who are surviving and who are going to return 100% of capital to their investors because they weren't over levered and they weren't paying like silly, 3.5 cap, type prices for these assets.
Right.
So if you do your due diligence going in and, invest with good operators, you're much more likely to have that good outcome.
You mentioned this briefly, the portfolio breakdown, and you've talked about like the traditional like the 60-40, the standard 60-40 portfolios being updated. So what are you seeing right now that's working? And obviously, understanding that at different seasons of people's lives, right? That breakdown is gonna change. So maybe walk us through the different seasons and what that breakdown, the breakdown that you've seen that as optimal, right, as you go through the seasons of life.
Yeah, that is a great question. I mean, I always start with the 60-40, to be honest. And you may be like, wait, the guy who started the Alternative Investment Podcast, his default recommendation is the 60-40. And I'm like, yeah, it is. Cause I want to assume that, an investor wants to be more passive, right? And wants a more just sort of balanced, easy portfolio. That's going to be like my default recommendation, without knowing any more details. But then once you get into the details, usually as investors get older, they want to shift more into bonds, right? So that's where like a 60-40, or maybe it started out even as 80-20. If you're investing in your 20s or your 30s, maybe you're invested 80% in equities and only 20% in bonds. As you get older, you tend to go from more risky investments to less risky investments, right? Because you don't have the ability to recover from those market drawdowns. So that's kind of my default, is like very plain vanilla, like whatever your neighborhood Charles Schwab or Vanguard representative would tell you. But then as far as alternatives go, like to me, that's a personal decision. Is this something you're interested in? Is this something that you want to put the time in to learn about? There really, if that's the case, there really is no set answer. Like if you put me on the spot, I would say, well, if you go to an alternatives conference, the big topic of conversation will be the 60-40 is dead, or the new 60-40 is now 50-30-20, right? So like you'll hear stuff like that. But I can tell you, I've talked to ultra high net worth individuals, and I'll never forget one that I talked to. And this is when I first started my show. And I asked him, and again, this gentleman, he has his own family office. He's very, very successful. And I asked him, just out of curiosity, what's your allocation to alternatives? You know what he said?
What?
100%.
Yeah. Okay.
Like 100%.
I was kind of leaning that way. I was like, okay. Yeah.
So, and this guy, this was like before, some of the stuff like occurred in 2021, 2022, like some of the, kind of wild market gyrations that we went through. And I can tell you that he weathered those quite well. So there's no real right or wrong answer. It comes down to your age, your investing goals, your temperament, how much work you're being willing to put in. Maybe that's a cop out, but I don't think it is, because I don't think your listeners really want to be, told like, here's what you have to do. There's not a right or wrong way to invest in alternatives. Well, no, there's a wrong way. There are many wrong ways, but.
Fair enough. Yeah, and I definitely know what you mean there. Well, Andy, we're coming up on time, and want to be respectful of that. So this has been absolutely incredible. I mean, I've got a lot of notes here, and the sad part is I had a lot of questions that I didn't get to. So maybe we'll have you on for part 2 or what have you. But in traditional Gould Mine fashion, want you to leave the entire audience with one final gold nugget. Take it away.
Well, shoot, my gold nugget. I think that this market that we're in, it feels like everyone is waiting, like they're waiting for the election, or they're waiting for interest rates to go down. Just like so many people are waiting. And my best advice is like, don't wait. There's good investments are happening every day. Good startups are being created every day. There are real estate deals out there that do pencil if you're, willing to go out and find them. And sometimes it's these market conditions where everyone else is inactive that end up being the best for those of us who are being active. So I guess that's my nugget for today in October of 2024.
I couldn't agree more. All the investors that I work with and have worked with over the last decade, I always tell them like, hey, remember, like no one makes money when everyone is spending. Right. Well, except, the people that are the businesses and stuff that are benefiting from that. But from an investment standpoint, if you're looking at investments only, when everyone else is scared, that's when you got to be diving into the market, because that's when the real money is. Like, do you think anyone was like applauding the people in 2009 that were buying all the houses? They're like, you're crazy. Stop it. Don't buy, their family, their friends, they went to Thanksgiving that year and they were hearing it from everyone. And now look at them. Right. I mean, those guys are they don't need to work another day in their lives if they didn't want to. Right. So I think it's an excellent point. And especially like, we don't know how long this period is going to last, right, Andy? I mean, I think a lot of people think, okay, well, after the election, after the rate, adjust here, speculatively, of course, we don't know that they're going to, but if rates adjust and once the election's over, then everything will go back to normal. Well, maybe not, right? So it's an interesting point. It's like, hey, these are the opportunities that everyone waits for. The problem is that when the opportunities present themselves, they're not perceived as opportunities because there's a lot of fear in the market. Well, if there was no fear in the market, then there would be no opportunity.
100%, Danny, 100%.
Right. So, hey man, this is great. Can't wait to have you on again.
All right. I appreciate it, Danny.